Good morning to our wonderful audience, and welcome back to Boutiques on Wednesdays. Interest rate cycles, asset class valuations, macroeconomic regime, geopolitics, elections, fundamental assessments of companies and securities, and so much more to consider when constructing multi-asset portfolios or funds. And that is exactly what we'll be deliberating on today. Joining us for this discussion, and my privilege to welcome three top fund managers: Paul McKeveney from Investec, Mark Seymour from Northstar Asset Management, and Arno Lawrence from Sasfin Asset Management. Good morning, gentlemen. An absolute pleasure to have you with us this morning. How are you doing?
Morning, Eugene.
All
good.
Very well, thanks,
Good
Eugene.
stuff. All good, all good. A bit chilly where I am. I'm not sure on your side what it feels like. A lot of ground to cover, so I'm just going to get right straight into it. And Paul, if I could maybe start with you. I mean, we've had Barry and some of the team presenting at our global conference and online sessions on the Investec BCI Dynamic Equity Fund and the Global Leaders Funds. Both funds doing exceptionally well. And you've got a whole array of mandates that you manage. But here's the thing. Very often when I engage with intermediaries, I talk about Investec and your team and the funds you manage, and then some of them will correct me and say, no, but the name was changed to 91. So no, I'm not talking about 91. I'm talking about Investec Asset Management Team, a huge team that's still there, running numerous mandates, some of which are mentioned now, and we'll dive into your multi-asset funds in a bit as well. But can you, for the audience sake, maybe give us a brief update on Investec Wealth and the asset management team and the capabilities you've got?
Sure, thanks, Eugene. I mean, it happens to us, more than you think. We'll go, pitch for some new assets, and we'll be told, no, we already have money with you. So there definitely is still a little bit of confusion out there in the market. So, just to reiterate, who we are and where we've come from. Investec Wealth and Investment has a long history going back to the mid-90s, and offering investment management services since the early 2000s. While 91, which is the previous Investec Asset Management, was part of Investec, we only really managed investments for our own clients, and we were limited in terms of the unit trust we could launch, how we could market them, and who we could distribute them to. Once 91 left, we were unshackled, as it were, and we ramped up our unitized investment offering, leveraging all that expertise in the segregated investment space, where we'd managed money over 20 years or so. We now have more than 25 funds, more than 250 billion under management, which would put us, just outside the top 10 asset managers by AUM. We've also got a specialized alternative investment team, doing asset classes like private debt and equity, as well as structured products for our clients, an area which is clearly going to become more and more important over time. So just to be very, very clear, we have not ever had anything to do with 91's investment processes, their research, etc. In fact, it used to annoy companies when they used to come to our old building, and they'd have to have two meetings, one with us and one with them, because they couldn't understand why they couldn't have them together, but really just driving home the fact that there was no overlap ever. We have an extremely strong client and investment focus across our business, and are obviously very excited to be partnering with clients who have a shared vision for their investments.
And I mean, a team that's been going for many years as well, a lot of expertise in that team. Your team all based in SA? Do you already have parts of a team based globally as well?
Absolutely globally. So Switzerland and the UK. Actually, Switzerland, UK.
Well, thank you for that, and for clarifying that. Arno, if I can maybe hop over to you. I mean, you no doubt to be one of the top fixed income managers in the country with a phenomenal track record. We've seen you progress through various companies, and now with Sasfin, also as Chief Investment Officer, you manage an array of funds. We're very familiar with your fixed income fund that you run. I'm sure with a lot of client portfolios that's on the call as well. But you also have multi-asset mandates. You've got the Sasfin Stable Fund, which is more absolutely return-orientated, focusing on capital protection. You've got the balance in the SA multi-asset medium equity, and then Prudential, which is in the SA multi-asset high equity fund. That's probably some of the funds we're going to look at in a little bit more depth this morning. But for the audience sake, I mean, can you give us a bit more insight to the strengths within that team and how that all comes together in running multi-asset mandates within Sasfin?
Yeah, thanks, Eugene. I think probably the one that is best known in the market is definitely the stable fund, Sasfin Stable Fund, which is managed by Errol Shear, which I'm sure many people know Errol from over the years. He's been working in markets longer than what I have as well. So, and very much in this space, which is that low equity, very much absolute return mindset, and Errol obviously has the track record that goes with that. As well, and certainly, having somebody on board in the team like that, as well as on the fixed income side that I bring in terms of my experience, is quite a nice blend. And then, of course, we've got the second tier of managers within Sasfin as well, also working and on the, let's call it the balance of prudential. In particular, I'll highlight Rafi Routine on the fixed income side, whom he has been on your sort of program before, covering fixed income. And then also probably for us as well, relatively new kid on the block for us in terms of at Sasfin, Sishle Siswana, on the equity side of things, and he's working very closely with Errol Shear. And certainly in terms of the balance and prudential, really is going to be the coordinating force behind that. So what we really bring in that multi-asset class space across those sort of various, low, medium, and high equity, really is a blend of, very deep and extensive experience, as well as the energy and insight that the next generation bring. I won't sort of call it the generation Zs or the millennials. I'm not sure where they fall, but certainly it's a very powerful combination, and it's a great sort of working team that basically harvests the best and sorry, I even forgot to mention Craig Pfeiffer as well,
Yes.
as investment strategist. He won't sort of wrap me over the knuckles for that one, I hope. So certainly, again, also a little bit of gray hair, and again, that blend of experience, as well as the energy and drive that the next generation brings. And again, I think that's really important from a succession planning side of things as well. In terms of ensuring that there's a continuity of thinking, through the fund. So if I use, Rafi as an example in that fixed income space, has been, with the Sasfin team, all the way through since the launch of all these funds. So, certainly, whilst there have been some new people coming in, including myself over the last 3.5 or 4 years, there is that continuity, and very much, in what I'm trying to do in terms of building the team is ensuring that, when people come and go, invariably as it does happen, people eventually retire, all those sorts of things, that there is that continuity of philosophy, and essentially fund strategy.
Well, no, thank you for that. Definitely a lot of depth in that team. And we're going to get a little bit more into your thinking when running a balanced mandate, or is a multi-asset high equity relative to an absolute return orientated mandate, and some of the thinking behind that. But before we do that, Mark, at Northstar, we've had you on the sessions before as well, heading up the Northstar VCI Income Fund. Very familiar with the fund. Also a good solid track record. We are going to be focusing a little bit more on your multi-asset mandate, or the Northstar VCI managed fund. I know you've got a global income, which are, I think, becoming a little bit more thematic or topical, people talking about it. You also have a global flexible fund, but we're going to focus on the managed because that's where all the working parts come together. When looking at strategic asset allocation, a typical SA multi-asset high equity fund, when you start the modeling on that starting point, different groups of assets will give you different outcomes over different periods. So it's very interesting to look at different companies modeling on strategic asset allocation and how they get to that starting point, because it's not about the past performance, it's about looking forward on asset class return. Can you give us a little bit more insight? I mean, how the thinking works in Northstar when you start modeling your strategic asset allocation model in a multi-asset high equity fund?
Yeah, thanks, Eugene. We're coming up for 12 years now in the latest iteration of Northstar. And I think, it's the first 10 years is, you faced your challenges. So we're at a point now where we've got a strong investment team, and like you say, how do you solve the problem of positioning a multi-asset product? So at Northstar, essentially all the products are multi-asset. They've got the across the risk spectrum, so the income fund, a low risk product, which is a multi-asset product. We've got the balance fund, which sits in the middle. Even the equity fund that has the consideration of buying global assets has that multi-asset consideration. And then, essentially, the global flexible fund, obviously the majority of returns are generated by global equities, but it's also a multi-asset product. So for all intents and purposes, all our products feed off the sort of multi-asset process. And so just to be quick about this, is all the thinking that we do essentially resides that goes into a buy list, and there are different components on that buy list. There's global equities, there's local equities, there's fixed income, offshore fixed income, and alternative assets as well. And so I think what kind of distinguishes Northstar is that each analyst has a footprint on that buy list, and by doing that and keeping that buy list up to date, we then can integrate all that work into all the portfolios, and that's done through an optimization process. So each portfolio targeting a specific risk level, and then it becomes quite a seamless process of integrating everybody's thinking into the portfolio. So for all intents and purposes, each portfolio is a function of what each analyst has to bring to the party. We can unpack that process. I mean, it's also worth mentioning that it's not an easy problem to solve, because over the last 10 years we've obviously gone through building a team, and with that you've had team members that have come and gone, and we pay homage to the previous or team members that have passed through Northstar that have helped us shape what we have currently.
Looking at that optimization modeling in your buy list, and looking at the different asset classes and when returns may come from, Mark, your thinking when it comes to returns, especially when it comes to global assets, is currency one of those factors that comes into that model? And I mean, especially where we are now with the rand trading a little bit stronger, and I don't want to get into debate, where the rand's going tomorrow, because we don't know. But how do you pull those kind of things into a multi-asset model?
Yeah, so I think then the world of macroeconomics, I mean, a lot of those variables are clearly very difficult to call. We do try and apply our minds to the best of our ability, but we also do lean on consensus sell-side views on some of those big macro themes and calls. And definitely, currency call has a massive impact on portfolio positioning. So when it comes down to that buy list, it's all distilled into an intrinsic value discount and what the implication is for the returns from each of those different assets, and where those returns are expressed as in terms of dollars, in terms of how that filters through to the local portfolios. We need to overlay a view on the currency, it's one of those factors, and also within the global portfolios, the currency consideration is also huge, and so we need to find ways of balancing those risks and being pragmatic about what the implication is for some of those those variables.
We're going to unpack that in a little more detail in a bit. But Paul, if I can maybe come back to you, I mean, you've given us good insight into the business. Very strong team covering all asset classes locally and globally. Massive amount of assets under management, which I didn't realize. So I think news to a lot of us. Big team indeed. But what are some of those macro discussions currently coming into your asset allocation meetings? Or is it all about, if you look at tactical asset allocation at the moment, is it just fundamentals, bottoms up process? Or is there macros that you're worried about now? And what are some of those macros? Your mic, Paul, sorry. I still do it every day.
Sorry.
No problem.
I wish it would just turn itself on when you try to speak, but anyway.
Exactly.
So we obviously, think that macro is very important, and we try and integrate both macro top-down and fundamental bottom-up processes, and obviously then construct our multi-asset portfolios based on that tactical asset allocation overlay, and then using the building blocks that we have within the business. So I guess what does that mean practically? I think everybody would say they've got some sort of top-down and bottom-up process. We think that global investment tides and currents tend to lift and sink all boats. So our investment process starts with our global investment strategy group, which helps set our global investment businesses risk budgets on an equity equivalent risk scale of -3 to +3. How we do that? Well, the group is made up of colleagues based in London, Switzerland, and South Africa, and includes economists, strategists, and senior fund managers from across the business. We meet at least quarterly and have to complete a very detailed survey around our views on markets, threats, icebergs, opportunities on about a 12 to 18-month investment horizon. That output is then taken into the regional asset allocation committees and used then to tailor the regional specific views, be it in Switzerland, the UK, or South Africa. It becomes a very nuanced discussion in those regional asset allocation committees, what the views on international markets will have on SA assets. The output is similar in terms of what our global investment strategy group provides in terms of that -3 to +3 on an equity equivalent risk score. And that then filters down into the single asset specialities or the building blocks that we use within the multi-asset products. So, within those single asset specialities, the focus from the analysts is obviously very bottom up and will be informed by what the top-down view is, but still very focused on kicking the tires and finding great ideas. So for us, the macro is very important. While we sit here in South Africa, a lot of the international, what's happening over there or out there is going to drive what happens here. So it absolutely filters through our entire investment process. But at the building block level, there's a lot of fundamental work being done by analysts in terms of, finding those best investment ideas. I mean, if you wanted me to come back to the specific views around, how we're thinking now, I can elaborate on that, but I'm conscious that I've probably chatted.
We're gonna come to that just now, Paul, because I think it's very important. But I want to continue with part of this conversation because I find how you construct your portfolio, specifically the Investec BCI Balance Fund, very interesting. You made mention now to some of those building blocks and how some of those ideas come together. You include funds like the Global Leaders Dynamic Equity Fund in your high equity. So it's almost like building blocks within your investment stable. Do you find that using building blocks where all those expertise lie work better in a multi-asset portfolio as opposed to just buying those underlying securities directly? Or how does that work?
Well, although we obviously are a very integrated investment team, and we work, the guys managing the Global Leaders Fund, the Dynamic Equity Fund, as well as our long-term growth SA equity building block. We've all worked together for a very long time. We sit on the same desk. We're on calls every other day about what's going on. So although we mention them as strategies, we effectively consolidate them within our fund into one view of our equity exposure. So and why is that an advantage? Well, it helps us have a very good understanding of, I guess, portfolio risk, so we don't compound risk taking, which sometimes happen when you're using other external managers to help implement some of that. We also access parts of the market that other larger managers struggle to, especially in the case of the Dynamic Equity Fund, which allows us to capture the small and mid cap exposure that some other guys will struggle with. And then lastly, importantly, allows us to keep the cost down, because we aren't paying away a lot of those fees. So, where we have a strong process and a strong team, we'll absolutely rather use our own building blocks, but it's not a case of, externalizing or allowing teams that we're not close to manage the assets that we look at. We're very, very integrated with both the international and the local equity investment processes.
Very interesting indeed. I don't know if we can maybe stick to some of the macros, and I mean more specifically, the interest rate cycle, very much topical at the moment. We all understand why. There's also discussions, we've seen the ECB cut. Will the SARB cut before the Fed, and what the impact of that will be? Will SARB wait for the Fed whenever the Fed may cut or may not cut this year? I'm not going to call it. We got it wrong too often this year, so I'm not making any more comments on that. But surely this must have a significant impact on all asset classes and our currency. What are some of those outcomes of those discussions at the moment around the interest rate cycle, and how does that impact on your tactical asset allocating decisions at the moment?
Yeah, that's quite a very broad
Loaded,
yes. But I'm going to try and get it into a nutshell type of thing. I think obviously, very similar to what Paul was talking about, is that this blend of top down versus bottom up, stock picking type stuff, and the top down really determining a lot of the asset allocation side of things. So in other words, a broad exposure to a single asset class versus then in the equity space, a sort of a bottom up sort of type of approach. And obviously the interest rate side of things is fundamental to both of those, because when you start doing the stock picking side, if you're going to be working what sort of intrinsic value is, etc., what the level of interest rates is going to determine that discounting factor. So it's extremely important, and as you rightfully say, getting it right is obviously one of the prime requirements that you sit down as a team in terms of determining that. And again, if one thinks about where and when the Fed is going to cut, I mean, sort of the last quarter of 2023, the markets were getting very excited about the fact that, rate cuts were imminent. And here we are, getting into June, and there's still uncertainty as to, when is the first one sort of coming? Is it July? Is it September? Is it 1? Is it 3 this year? So I think where we've sort of ultimately landed on is probably, pretty much where the market consensus is, that at least 1 for this year. I think the problem the market's having at the moment is that when you get these turning points in the economy, is the data is very messy. So you have the leads and lags. So you get one set of data that is very dovish, and then the next week you get another set of data that is it looks at the economy and you think this economy is flying. And so then you have this divergence of thinking. And so our job really then as fund managers, when we sit around, is to try and look through that sort of noise, and the sort of volatility or the noise that you're going to find from the cycle, and then try and determine what the positioning should be. So if I use just what you alluded to earlier, which is the currency side of things, because again, interest rate differentials are going to determine what the currency is going to be doing. But if I use the rand, if you take a longer term chart of the rand, you could probably, if you took out the title and said it's the rand, you could probably say that's the S&P 500 or something. You wouldn't be able to determine it, and that's the point about long-term investing, right? Which is that you can get a rough sense of what the trend is. So you don't have to time it specifically within a fund. So what we're not trying to do is to try and pick the top or the bottom of the rand. I think what you try to do is have a strategic longer run allocation towards offshore, and then so within the stable fund, generally speaking, because it's a sort of an absolute return fund, we're not going to try and stock pick. We're just going to have broad global exposure, which we will use via ETFs. So it's that sort of low cost approach to it. And then as you sort of move towards the sort of the higher risk profile side of things, so that's in balanced, and then prudential being high equity, your offshore component will then be a blend. You would have some sort of passive exposure, but you'd also blend it with active management, which was what Craig and his team brings in terms of their sort of, in particular, quality growth is their focus. And obviously where we are at the moment in the cycle is quality growth is going to steer you towards, probably a big, segment of tech. And we can talk about and exchange views around what the tech market is telling us about the economy versus what the rest of the market is telling us about the economy. So as I've said, those are also valuation issues that you need to bring into account as well. So it's not just about, going into something because it's performing. That's essentially a momentum strategy. I think in terms of our approach for offshore in particular, it's the blend of the quality growth, as well as a little bit more defensive in terms of focusing on the dividend side of things, as well as there can also be some regional tilts from time to time as well.
Very briefly, if you talk about ETFs that you buy specifically in the stable, would that be something like the MSCI, or do you try to diversify a bit more globally?
Yeah, so we would, for example, very definitely, like it would be, the Vanguard sort of global exposure. So it's very much similar to that, basically.
Oh, no, thanks for that. Mark, staying with tactical allocation, I mean, some DFMs will argue that, through tactical allocation, you can actually destroy value. And we've heard these arguments from, obviously, some of your more non-active fund promoters, or passives, call it what you want. And we understand they're talking up the shop, obviously, static asset allocation. And if you think about it, maybe it's true, because if you believe that equities will give you superior returns over long periods of time, there is a potential that through tactical asset allocation, you can, with periods, be underweight and you miss some of that. What is your views around tactical asset allocation? Does it add value to portfolios? And how do you see that in your funds?
Yeah, so I mean, it's obviously it might be a contentious issue. These are my views in terms of tactical allocation. Primarily what we're doing when it comes to positioning the portfolios, it's based on our forward views on the markets, and that's valuations, it's the macroeconomics, everything mixed in. I think what is very underappreciated is over the last 10, 15 years, the markets have been very, very influenced by central banks. So they've been extremely active, almost overactive compared to the long history. And I think to a large degree, it's played into passive products. So essentially, what you've had is, by taking a passive approach, there's been quite wild distortions in the markets in terms of valuations. And I think we've been led down a path where, by simply looking at historic returns at headline asset class levels, you get a sense that, unless you've beaten those mix of assets, you haven't added value. But what is very underappreciated, in my opinion, is the amount of risk that's embedded in those passive constructs. And so the value add in terms of tactical asset allocation, I think, is very highly underappreciated. And I think that's the space that we play in. We're active managers, we're forward looking, we do all the fundamental work, and we're doing a lot of risk management. And so, you can look at the portfolios, our portfolios, our income fund, we've outperformed our strategic benchmark, and we've done it at a lower risk. The Global Flexible Fund, the same story. The Managed Fund, we've performed in line with peers, but we would argue that we've done it at significantly lower risk. And whether you measure that in terms of standard deviation, drawdowns, or value at risk, I think that's the value that active managers like ourselves and the other panelists, that's what we bring to the table. So yeah, I mean, I think that summarizes my views.
I think that sums it up. It's got a lot to do with that risk management and giving that investor a better ride over time. I've mentioned it before, and I still say it. It's not markets that destroy capital, it's investors, because they can't stomach risk in a particular portfolio, and that's what you guys do exceptionally well. Paul, if I can maybe come back to you very quickly. In the Investec Balanced Fund, SA multi-asset high equity. You've mentioned before that a high equity fund should be high in equity. Does that imply that you will typically be on average higher in equity than the peer group? Or how do you view that? Are you by nature more bullish in a longer term or multi-asset high equity mandate?
Well, I think it comes back to, I think for us, your fund should do what it says on the tin, and we're not trying to be a massively flexible manager here. So, I think that, the way that our clients are using this fund for long-term capital growth, they're typically in some sort of, retirement saving structure of some sort. So they've got, really long-term investment horizons and are typically able to handle drawdowns a little bit better. Which, to us, this means that, they should on average have a high growth asset allocation to allow them to harvest that equity risk premium over time. So when we look, both quantitatively and qualitatively at the performance of the fund versus peers, we would typically have had higher equity weights through the cycle, based on, what we can understand, our major peers look like, as well as, the beta to those peers. But, to add a nuance to that, Mark was touching on the risk-adjusted numbers. I think the risk management frameworks are sometimes, underappreciated by investors, and you can use the example of, the concentration in the markets today, but also, NASPERS a couple of years ago, where, active equity managers in South Africa, looked terrible if they underperformed because NASPERS was going up, but they were actually didn't want to be at 25% versus 20. So was that a bad decision? I think probably not from a risk management perspective, but I think if you're just looking at performance, you wouldn't have appreciated that. And I'd make the same case for maybe some of the S&P 500 today. But just to add one more nuance to that, I mean, saying that you've got lots of growth assets is one thing, but something we're trying to focus a lot more on, and I think you would have seen it in our risk numbers as well over the last couple of years, is that on a risk-adjusted basis, we've done a pretty good job of balancing the the high equity growth allocation we have with good risk-adjusted returns in terms of, however you want to look at it, in terms of, what Mark was mentioning in terms of, drawdowns, downside deviation, etc. So what we have been working a lot on in our strategic asset allocation is trying to introduce more loss aversion work. A lot of, that simple mean variance optimization, that has historically been done, doesn't always talk about, how do we protect on the drawdown, on the, what's happening in the tail of your portfolio. So a lot of that work is, I think, becoming more and more recognized and something we're bringing into that high equity solution. So trying to give our clients, that high equity allocation over time. We're not going to deviate, too much via the tactical asset allocation process, because we don't want to be, get it wrong, be underweight 20% equities and the market actually goes up, and then clients are saying, well, I've had a 20-year investment horizon and we've struggled here, what's going on? So that's the balancing act. Have high growth assets over time because the way the clients are using this fund, but try and protect them against, those drawdowns, which sometimes is where the mistakes are made for investors.
Well, thank you very much for that. Arno, just very quickly going back to election outcomes. I mean, also being a lot of talk about that when you look at SA markets, specifically SA equity and SA bonds. I think most of us will agree that the electoral outcomes was positive. A lot need to happen from this point going forward. I think a lot of politicians are eating humble pie as it stands now, and we're going to see an announcement of the cabinet soon. That's going to be interesting as well. But time will tell if politicians are going to play nice in the interest of the country, or is it just another power play? We'll see. But given where we are now, looking at SA equity and SA bonds, does the outcomes provide you with enough insight to make any high conviction calls on either SA equity or SA nominal bonds? And how do you play the two relative to each other?
Yeah, it's such an interesting question, Eugene, and it actually follows on from what Paul was actually talking about, because we sort of have a little bit of a conundrum as local investors in South Africa, which is that when you look at the growth asset side of things, the equity market in South Africa, number one, there was a period in which concentration risk was obviously one of the key distortions within the market, number one. And then number two is that over the last 10 years, those growth assets have barely kept pace with your fixed income returns. So when you're doing an asset allocation call and you start saying, okay, if it's a high equity fund, and if you want to actually sort of limit the downside, and your expected returns on the equity space are actually barely keeping pace with bond market returns, there's something wrong in the market. And that something wrong really speaks to where we are now with the election cycle, which is that it's really about the economy stupid, right? It's that sort of thing. And we know the economy has been constrained for various reasons. We don't have to go into the reasons for that, for various things. And the key thing now is that has always been the question. We know that South African assets are cheap, both fixed income and equity. We know that. The key then is, can you see an unlock of the value, and can you see a path to the unlock? And I think up until this election, you would have really struggled to have said that you can see a clear path to a value unlock in South Africa. And as long as that remained the case, then, you could always argue then that, there were better opportunities offshore, even if you then hedged them back into rands, et cetera, et cetera. So that's a lot of debate that you can go through. But I think what we've had now with this election, and yes, the results were, I think, well, a surprise to probably a big chunk of politicians, never mind the actual population, in terms of the polls and that, because it was probably consensus was that ANC was going to get around 46, 47%. And so, yes, this was a surprise. And now the question is, well, what does that actually mean? And I think that there were two things here. Is one, you now can see potentially a path to the value unlock if we are able to get a change in economic policy. And I think that's what the premise of this, I was going to say coalition government of national unity, potentially puts on the table. And so it's the reason why you saw bond yields drop dramatically, why the rand strengthened, why the equity market ran, because now you can see the unlock of the value. So, definitely that is the case. I think some of the little bumpy rides that we've had in the last couple of days around the negotiations about who gets what, it has been a little bit disconcerting, but I think that should have been expected. And I think then the other angle that I would probably put on the table here is that, going into the election, it would have been very hard to have bets on an outcome. That was an extreme sort of either a really bad outcome or a very positive outcome. And so, what we did as a team was to say, you can't go with an extreme position in terms of a tactical shift within your either asset classes or even intra-asset class. And so it was essentially fairly neutral. But then the key thing to be able to do, and I think this is what you can do in boutique asset managers, is that you can, once you've essentially analyzed the results, and you can then see the path to the unlock, is that ability to move very quickly. So we went, for example, from being neutral in, for example, in the fixed income duration side to max within the space of 2 days. And then similarly, you can position as well in terms of local versus, offshore as well. So I think those are, the elements of being able to essentially deal with a new scenario, which you can't forecast, number one. So then it's new information. How do you process it? What does it mean for the future? Is there an unlock of value? Because again, if it wasn't a good outcome, we could be sitting for the next 10 years where equity markets in South Africa could stagnate to the extent that you again, it's probably better off on a risk-adjusted basis to just sit with fixed income. So I think, yes, we certainly will probably see hopefully, if things work out okay, domestically, we are in a better place as a country and and potentially the economy than what we were, let's call it, a month ago.
I totally agree with that. And I mean, lots of moving parts that you need to watch continuously all the time. There isn't a static answer for the next 6 months, is there? Mark, just very quickly, sticking to SA equity. SA is a commodity-driven economy. We still export more rocks than cars. Most quality managers would say that, commodities doesn't have any pricing power. Are we not at a very interesting junction that you actually need to consider commodities in your equity carve-out?
Yeah, no, it's a interesting question. But, I think just to reflect on what Arno was saying, I think we've, probably articulated a slightly different way, but, it's been exactly that, shift, where, arguably, the risk premium that was being applied to South African assets was just way too distorted. And I think exactly that, these positive outcomes is changed that expectations. And yeah, so we've been very much on the same page our buy lists have been dictating that we have, longer duration in our fixed income portfolios, and also a stronger skew to South African assets. And so that has hurt a little in the last 2 years. But we've been very nicely positioned for this very aggressive move that we've seen in the markets. Just in terms of the question around commodities, there's no question that South Africa is highly dependent on the highs and lows of the demand for commodities. And I know it's been difficult problem to solve within the local equity portfolio, specifically with the kind of focus that we have as an asset manager, which is just a stronger preference for quality assets, which is a lot easier to exercise in the global arena. But certainly there are some great companies locally, but obviously at an index level, it's quite it's like Arno said, you have this concentration risk. So we've in terms of that, our local equity expression in the buy list, we've been a little more pragmatic. If you rewind 6, 7, 8 years, we operated in the sort of 6, 7, 8, 9% tracking error range, which can be can really pay off. There's some local asset managers that do operate in that space. We've just toned down our tracking error to deal with that, and we operate in sort of the 2 to 4% range. And our local equity portion of the portfolio has been performing a lot better, especially over the last 4 years. So we've been generating some decent alpha there, whereas before it was a little more erratic. And to come finally to your question, in terms of that commodity exposure, we've been a lot more pragmatic and a lot more practical, and been a lot more effective in terms of our exposure to commodities. And then, in terms of the bigger picture, obviously commodities has had massively wild swings as we went through the COVID crisis. And I think, without getting into the macroeconomics, we find ourselves in a position where fiscal policy is playing a larger and larger role in terms of the impact on pricing. And we're potentially at a point where commodities is finding a lot more support. And so these are very challenging questions for our analysts that do in the local equity space. And for that reason, arguably our resource exposure is meaningfully higher than it has been, let's say if we rewind 6, 7 years.
Very interesting indeed. And while we're on resources, I see you've got allocation to gold. All your portfolios, especially global flexible. Is that a macro play?
It's definitely a macro play. It's a diversification expression. You can take a long history view of the different asset classes, and it becomes very difficult to argue that gold shouldn't be in the portfolio. We've done extensive back testing across different time frames, and for all intents and purposes, a 5% allocation to gold across all different risk spectrums certainly makes sense. The next question is, whether the gold price is going to go up or down, and that is, I'm sure Arno and Paul would agree that it's a difficult call. But if we think big picture, just in terms of my big picture framework, what's quite an interesting fact is that the money supply in the US over the last 50 plus years has been increasing at 7% a year. Their gold reserves have not been increasing. And if you look at the long history of gold and the potential value that it adds in terms of an investment destination, a store of value, It's understandable why the gold price has gone up in dollar terms. You've got more dollars coming into the system, and
Yeah.
and no gold coming into the system. That the price is going to go up. The second point which is quite interesting, is that if you look at the US gold reserves over the last 100 years, going into the Second World War, the US had loads and loads of gold reserves, to the point where their currency was backed more than 2 times. They went into the Bretton Woods system, where the currencies were all pegged, and the dollar was pegged to gold. At that point in time, the value of the currencies in circulation equated to the value of the gold that they held. So that made a lot of sense. But then you had a scenario where that arrangement could not be held. It just wasn't practical, to the point where they defaulted on their obligation of providing gold in exchange for dollars. And that's when Nixon broke what do you want to call it, the Nixon shock, the default in 71. At that point in time, their currency was only backed 20% by the value of the gold that they had in reserves. And since then, you've had the gold price, which is essentially floated as a function of the market's views on the price of gold. And we had an interesting junction now where 71, the currency was backed 20% by gold. In 2000, that number went down to 12%. So for all intents and purposes, quite an attractive entry for gold. And then more recently, that value got to 18%, which is also arguably very low in terms of that historic perspective. And then obviously we've seen a strong run in the gold price, and at this point in time, the US currency is backed 26% by the amount of gold that they have in reserve. So that's just a little quick overview in terms of my sort of understanding of the gold market. Yeah.
Very, very quick answer, yes or no. Are you increasing gold or decreasing gold? Up or down?
Very quick answer, we actually underweight. The gold price has had a very strong, sharp rally.
Yeah.
And we're slightly underweight.
Got it, Mark. Thank you. Arno, you want to add to that quickly?
Yeah. It was actually, thanks for that, Mark, for that little history tour on the gold standard. It actually reminded me of, like, right at the beginning of my career, I was very fortunate to be mentored by an analyst who probably most people won't even know. And he did a lot of this work in the 80s and 90s. And I remember him sort of thumping the table and telling me the best asset you can add into your fund, to reduce risk, and in terms of diversification, is gold. And I've never ever forgotten that from that perspective. And I think it still holds true. If you do the analysis, you're still going to come up with that same answer as well. But I think the broad macro thing around the gold, and it alludes to what Mark was saying, which is that actually the big shift in the gold price that we've seen, and you asked the question, who's been buying? And it's actually been the big central banks outside of the US side of things. So, China in particular, and India. And that really speaks to the geopolitics that we're in, and what they are trying to accomplish within, their currencies as well. But yeah, it's a very interesting
changing world indeed. Gents, we've got a clock chasing us. I've got red lights flashing my side. Very quickly, Paul, if I look at your global equity exposure relative to some of the large managers, we've seen large managers going full out in terms of Reg 28, 45%. You're sitting at about 17%. Why it's a lot lower compared to some of the larger managers. Why is that?
So I guess very, very quickly, I mentioned at the outset around the risk scoring kind of process we have for global and local. So offshore, we've been a little bit more worried about the outlook for offshore assets for some time. Initially predicated on that US recession risk, which is not as bad as it was, but that was kind of the initial shift for us to move underweight. So when the Regulation 28 rules changed and we could externalize a lot more, when we looked at our expected returns for the SA assets versus the offshore, we thought it didn't necessarily make sense to externalize just because we could externalize. So we've been a little bit more pragmatic around that process, which has meant though that we've kind of missed out a little bit on some of that offshore rally we saw from over the last kind of year and a half. But at the same time, fortunately, the kind of the stock picking or the contribution from the local equity processes have been very strong, and now we find ourselves quite well positioned as as we've actually upweighted our SA risk score to the highest it's probably ever been, relative to an underweight offshore score where we underweight equities and overweight bonds offshore. So we're quite low, but that's kind of mitigated a little bit by quite a high SA equity allocation, which sits at in the high 40s at the moment when you include property and preference shares, for example. So the overall equity exposure in the fund is still quite high, just more in favor of the SA equity plays right now. We definitely acknowledge that we want to get the strategic asset allocation weight up over time, but we're happy to sit and wait for things to unwind as hopefully we make a lot more money on the SA side and then externalize at a better rate.
Well, thank you very much for that. Very last question. I'm going to try to summarize some of the questions coming in from the audience. I'm going to pass it to you. The one issue specifically is on SA bonds. Are we going to see some capital growth or capital coming out of nominal bonds? I mean, we've been talking about it for many, many years. We haven't seen it yet. And then, loaded question, is it time to go underweight SA multi-asset income in favor of SA equities and SA property? Or is it too early? Aha.
Okay. Okay, so on the fixed income side, as I've said, like the election does provide you with a path if they sort of choose the pragmatic route. I think that's really the best we can ask for, which is that it's not going to be when everybody's unhappy, that's probably going to be when the DA is unhappy and the ANC is unhappy with this sort of thing, you'll probably find that there's a more pragmatic economic policy. If that is the case, then what you do is you start creating, number one, local confidence, higher than what we've been, and number two is then foreigners start investing again. And so then that capital flow, you can definitely see a path to lower bond yields. So it's an unwind of all of that excess risk premium that's been embedded in the South African bond yields. But again, so the question is, we've already seen some capital gain. Can we see more? I think the answer is yes, we can. It might be a little bit bumpy over the course of the next month or so, but certainly I can see more capital gain from the bond market. So what you're getting then from the bond market is, and I said this to a set of clients yesterday, which is that, never forget the income component of the bond return, which is sitting at over 10%. So you can put that in your pocket and you can start the year and say, I've got 10% in the bag already. And now there's, is there a little bit of capital loss or a bit of capital gain over and above that? And, and I think we're in the situation now, fortunately, where you can start banking some of the capital gains, whereas the past couple of years, because of the global bond market, etc., we've had more capital losses than capital gains. And then that second part of the question is, shift away from multi-asset income. I think was it to what was the question?
Out of multi-asset income, more in favor of SA property and SA equity.
Yeah, that's probably a really good question. I think the property one, we did see probably the post-COVID recovery, and then there was a sort of a bit of a fallback again on that, and it was very much around what the economy is doing. So the economy is still growing at 1%. So all the promise is there, but it still has to be delivered. So I think it's, in my mind, I still think it's a little bit too early, because you are going to get some capital gain coming out of the bond market. So the multi-asset income space, the returns are going to look great. All things considered, in a sense, and then SA Inc. Certainly in a better economic environment, it unlocks, as we always talk about, the cash on the balance sheets. There could be a positive spiral here. If that is the case, then certainly yes, you will definitely be able to argue that on a projected return basis, the equity market should then deliver again like it should.
Oh, no, thank you very much for that, Paul. Very, very, very last question speaks to global equity. You are a little bit like to explain that, but the whole issue around global equity specifically, if you look at that carve out, do you look at developed markets only? Do you start to include more favorable valuations in an emerging market space? Or if you're in a multi-asset fund, do you say that my SA equity is actually already emerging market, some of global equities only going to be developed market. How do you think about that? Very quick answer.
Quick answer is I think that historically you could have got away with that. South African equities with the commodities and Naspers exposure gave you pretty high EM correlation. So sure you could just say that, but I think at the same time, you got to a point at which EM has been mainly driven by China. China's on the wane. There's other EMs on the up, and you've got a much higher offshore allocation you can use within your funds. So I think managers are going to have to be a lot more active in the EM space in terms of actually focusing that exposure into the likes of if you ever get a chance to buy India, if it ever derates a little bit, you've got to start looking, I think, outside of China and outside of South Africa for your EM exposure. And you've got the space to do so. You've obviously got that 45% you can go up to. So definitely.
Paul, very last question from the audience. It speaks to your product range. We can see all the funds on the BCI website. There's about 16 funds, invested funds. Do you have other products as well, other than BCI funds?
Yeah, absolutely. I mean, there's the the full offshore range, which will be domiciled as PCC structures.
Yes.
And and then there's obviously some feeder funds, I think, for a lot of those solutions on the platform. And then obviously outside of that, all of those strategies are also offered on a segregated basis for clients who prefer owning the strategies directly.
Gentlemen, we are very much over time. Like I said, I'm getting red lights flashing here and messages coming into my phone. To our audience, there's a couple of really good questions that's outstanding that we can unfortunately not get to. We've tried to circulate those questions to the panelists, and they can all provide comments on that. There's some anonymous attendees that I can't see who asked the question, but we'll try to field that in general as well and send that out with the recording. This has been a very, very insightful session indeed. I really wish we had more time to unpack so much more. To Mark, Arno, Paul, thank you so much. We tried to cover a hell of a lot of ground and speak a little bit to your business as well. Very insightful, like what you're all doing. All the information on their product ranges are available on the BCI website, or contact one of our team and we'll get you in touch with any of the teams from Investec, Northstar, and Sasfin. To our audience, thank you so much. Quick reminder, 3rd of July, next week, Wednesday, Global Equity with Frida and Lindsay Crane, and we'll focus a little bit more on that. To our audience, again, thank you so much for attending. Gentlemen, thank you for your time. Really appreciate it, and we'll chat to you very soon again. Thank you.